Hello and welcome to Realty Buzz. If you want to know what's buzzing in and around the real estate industry, then this is the show for you. I am Mansee and let's get started with the updates for the day. The first news on board says foreign investors can own land in Maldives. The Maldives Parliament passed a bill on amending the constitution allowing anyone to lease land in the Maldives on a freehold basis. The Maldives has allowed foreign investors with a minimum of $1 billion to lease land in the Indian Ocean nation on a freehold basis, in a development that would be watched closely by India, especially with China having a major presence there. Of the 84 members present, 70 members voted in favor of the bill, with 14 against and no abstentions. The bill brought out by government MP Ahmed Nihan Hussain Manik states that any investor investing a minimum of $1 billion can freehold the land if the project area is 70% reclaimed for the project. Additionally, an amendment to Article 251, Section B also states that the maximum period the land can be given is 99 years. The land allocated to freehold under the amendments is 10% of the total land areas in Maldives. China is also involved in and funding many infrastructure projects in the Maldives. These include upgrading Maldives International Airport, a cross-sea bridge linking capital Male with the nearby Hulhule Island, and the establishment of a special economic zone in the north, which are all closely related to the construction of the 21st century Maritime Silk Road. The country's longest high-quality road will also be constructed by Chinese firms. Here we go for a short break. Post-break, we will give you 7 tips which entrepreneurs need to know before investing in real estate. So stay tuned. Look at previous year's tax returns, property tax bills, maintenance records, etc. to get a good idea of the real income and expense. Welcome back after the break. Let's take a look at what are the 7 tips which entrepreneurs need to know before they invest in real estate. The question is, why should an entrepreneur invest in the first place? The answer to it is to have enough money to live on when we no longer can or wish to work. To put that money aside, however, we wish to accumulate enough of offset inflation and the taxes that erode our savings. And for that purpose, real estate is an excellent solution. The great thing about real estate is that even in a bad economy, it will usually fare better than stocks. Land, after all, is the finite resource. People need a place to live, work, shop and play. So real estate is really just a matter of supply and demand. What's more, real estate will continue to appreciate despite occasional slowdowns in the economy. In fact, it's proven to be the best way to create wealth, and an investor need not be a genius or a millionaire to succeed. Here are some of the tips then for entrepreneurs on getting started and succeeding in real estate investing. The first tip to succeed in real estate investing is do plan your financial goals. Before you buy the first property or do your first analysis, determine what you expect from your investments. What are your financial goals? We often discuss the time versus money concept. The more you have for one, the less you need of other to reach your financial goals. This means that you shouldn't shy away from taking the time to understand your goals and make sure each investment is a step towards achieving them. If you are unsure exactly how to create financial goals, meeting with the financial advisor is an excellent first step. The next tip, probably a very important one. Don't spend a fortune on books, tapes and seminars. Then just put all of that information on a shelf. You absolutely do need to learn some basics before venturing into investing. So be sure to do some studying, but don't let buying and collecting information becoming your end game. Having goals in mind will make the process much more straightforward. It's easy to get so tied up in the research phase that you never actually take action. Instead, write down specific questions you want answers or goals you want to meet before delving into the least books, seminar, etc. The next tip, a very important one in order to invest. Do look at plenty of properties. Don't just grab the first property you look at. Too many investors buy properties because they look nice, or the investors don't want to put the work in to look at what's really out there. Remember, you won't be living there, so don't make your investment decision based on your personal preferences. While you shouldn't fall into the trap of analysis paralysis, make sure that you're thorough and looking through properties. Give yourself a wide range of options, then narrow them down based on the criteria you have for yourself. The next tip, don't postpone starting your investment program because you're waiting for that dream unicorn deal. That's the flip side to number 3. Of course, Plenty of beginning investors suffer from a better deal maybe just around the corner syndrome. This can backfire in a big way, and you could potentially let a great deal slip just because you're holding out for something better. Your task may feel difficult if this is your first property, but you must realize that the perfect deal rarely exists. Better to execute on a deal that meets most of your criteria than wait for another that may never come. The next tip: do a thorough financial analysis. Be realistic. Look at different alternatives to determine which makes the most financial sense, and never buy property at a higher price or on less attractive terms than your analysis said made sense. Be wary of sellers that try to overestimate the value of the property through pro forma, which is estimated data. While you can certainly use a pro forma to start the conversation, make sure you know the real numbers before closing. Look at previous year's tax returns, property tax bills, maintenance records, etc. to get a good idea of the real income and expense. The most important figures you should know are net income, cash flow, return on investment, capital rate, cash on cash return, total return on investment. In each case, investment refers to how much you invest in property. Debt financing refers to your loans you may have to take out to buy the property. And total return refers to cash flow, equity accrual, appreciation, and taxes. Once you have understood these figures, you should have enough information to determine whether or not acquiring the property fits with your financial goals or no. The sixth tip, which is an observation in itself: don't try to buy a property that the seller is not motivated to sell. I'll tell you why. If the seller is motivated to sell, you are not likely to get the price best aligned with your financial goals. So, how do you know if the seller is motivated? Look at the asking price. For example, if the property has been on the market for a year for say $2 lakh with little to no price reduction, the seller is clearly not very motivated to move to the property. However, if that same property has been on the market for a year and has had its price moved down considerably, the seller most likely wants to do whatever it takes to get the property off his or her hands. Of course, this raises the question of how to find motivated sellers. See, there are many approaches, and not all of these will work for you depending on what property you want. But a few trusted methods include attending open houses, looking for vacant, unattractive properties that are for sale. Spread the word about yourself and what properties you are looking for truly. Going the old-fashioned route and looking in the classifieds of your local paper. There are just a few ways to find sellers, but there are potentially dozens of other methods depending on what type of property you are looking for. The next tip, the last one and the most important one: do know the difference between the real estate investing and the business of real estate. As an entrepreneur, you already have a business, and real estate investing is best used to support that business, not replace it, unless that's your intention. In other words, don't get so caught up in executing transactions that your core business falters. If that happens, you will be facing a bumpy road to get back to stability, unless your business is itself real estate or you are looking to get into the business full time. Always remember that pursuing these deals is means to an end, not an end into yourself or itself. So if you are interested in staying ahead of taxes and inflation while building security for the future, real estate investing may be for you. So what are you waiting for? You have the 7 tips. You can get set and go. On this note, it's a wraparound for this episode of Realty Buzz. We will be back with more on this. Till then, keep watching Spin TV. Goodbye and take care.